Today we are talking about an important aspect of a contractor sale here in the Lowcountry of South Carolina, and that has to do with appraisals. The pertinence relative to market value, what happens if they come in under the contract price, and how we navigate and negotiate that process. All right, Chris, so as we talk about things sort of normalizing in real estate deals, the pandemic market where everything was a cash purchase was not normal. So now we're dealing with lenders being more involved in transactions, and with lenders come appraisers. And appraisers are great, right? We appreciate, acknowledge the necessary process of that. We recognize that the appraisal is really the bank's way of validating and approving this property's value as collateral for the mortgage, right? Yeah. So, when there's a financing contingency in a contractor sale, the lender's going at that two ways. One is, do they approve the property and its value? Do they think it's in line with market? Well, that's where the appraiser comes in. And of course, then they're going to determine if the borrower is, capable of paying the loan back, right?
Right, so, and they're going to base their loan decision on the lower of either the appraised value of the appraisal that comes in or the contract price.
Yeah, and so all of a sudden, increasingly, we're having appraisals be part of a contract process. And let's say a typical appraisal period is, maybe 30 days or something like that, right? So we're recognizing, though, that appraisers are going to be doing the best that they can to read about that particular property and all the relevant and comparable data around that transaction to try to do their best to validate the purchase price between the purchaser and the seller. And really, the purchaser and the seller are the folks in the open market, theoretically, without any outside influence, that came together and said, hey, we kind of agree this is the value of this property, right? And the appraiser's coming in and doing the best that they can to validate that for the bank. One of the things that the appraiser's looking at is, what's the mood of the market? Are things still appreciating at a high level? Have things kind of flattened out? Are they seeing some trending where maybe it's a market in decline? And when you have an appraiser that's particularly sensitive to that, it can lead to some challenges if they feel like, I don't know, that purchase price that the seller and the buyer came up with seems a little rich. Maybe the market isn't quite there. What do we do with that? What are the consequences if an appraisal comes in less than the contract value?
Right, and that can happen when an appraiser looks at, let's just say, the comps, the transactions that happened in the marketplace leading up to the sale. They also want to understand what the market's doing. And they utilize the monthly housing supply. They actually calculate the monthly housing supply in an appraisal. And we've spoken to that in prior videos. And so what they do is they may or may not apply a time adjustment to the sale. Okay. So if something sells at X, but the market is declining, they might apply a negative time adjustment to that, and that's going to actually bring that sale price, the net effect of that sale price down. Conversely, if appreciation is happening and there is justification for a positive time adjustment, if something contracted a month or two ago, but the market's going up, they may apply a positive time adjustment on that. So there is some play in that. Just because something sold at X, there could be some variability in where that ends up on an appraisal. Right. And so with that being said, like you were just mentioning, there are scenarios that happen, and more so when a market's either flat or when a market is starting to go down or a market is slow, where maybe the appraisal does not match up with the contract price. Right.
So let's just say you've got a contract price at $500,000, appraisal comes in at $485,000, okay? And the borrower is getting an 80% loan to value, so there's just not a lot of wiggle room on that. What's the first step that comes to mind for you? We're the agents in the transaction. That's not great news that comes about. What's the first step? Are there ways to take a look at that appraisal? Nobody's perfect. Are there ways to take a look at the appraisal report and just make sure that everything's accurate? And if it weren't accurate, what would be the things that you'd be looking at typically just to make sure that that was all squared away?
Well, first and foremost, in that scenario that you're talking about, the client of that appraisal is actually the bank.
Sure.
Okay, so it's not the seller, it's not the buyer, it's not the agents. So an agent can't just pick up the phone and say, call the appraiser and say, send me a copy of that.
Of course.
They can't do that. So the client is the bank. So any interested party that's impacted by the appraisal would contact the bank and say, we'd like to see a copy of it. Now the bank is going to provide a copy to the buyer. But if the buyer is saying, hey, whoa, this is not right, they're probably going to provide the appraisal to the seller and say, we've got an issue that came up.
Well, so we've got a copy of that appraisal in hand. Let's say that we went through that cycle, all proper channels.
Okay.
We say, everybody, this is not great news. Let's just make sure there's no errors in there. What would the review, the quick sort of review of that appraisal demonstrate? Where might there be some hiccups on that?
Well, I think what's important is to look at things that are fact.
Sure,
okay?
Of course.
Because there are some subjective adjustments that an appraiser can make. There's condition and quality and view adjustments and all of that. And to argue those adjustments, I think that's not where...
That's tough.
But look at facts. I mean, was there a sale that was missed? Maybe there was a off-market sale that was missed. Or maybe a sale that took place, maybe it was a distressed sale. Maybe it was an estate sale. Maybe there was a need to sell it fast and sell it under market. So knowing about what the comps were and knowing the history of the comps is important. Also, for the subject property, is the size right? Did the appraiser measure the house physically, or did they extract the measurements from a third party?
Right, county records or something.
Is the size right? If the size is not right, if the bed or bathroom count is not right, if things like that that are material facts are incorrect, that's a good thing to bring up to the lender, who will then turn around and ask the appraiser to look at that again.
Sure.
So that's a good starting place.
So assuming we go through that, right, it's all been validated, and again,
good.
It's not suggesting that any appraiser would be inaccurate, but nobody's perfect and their errors can happen. So that's a first place to look. Next step, let's say that there's a financing contingency in the contract. It's come in $15,000 under contract value. The buyer's nervous about that. What's a way to protect a seller against that situation? Is there any way to put language in the contract that's established up front that sort of invalidates this being an issue?
Well, I think that's smart. I think anytime where you're in a market, maybe you have limited inventory, you have a very special property that you know is superior over some of the recent transactions. It could be a variety of reasons. I think it's important to establish that up front, and we might get to this in a second, but provide that type of information to the appraiser up front as opposed to after the fact, so that they have the right information to go. Now, Chip, if there is a gap, if it comes in light, then there's some certain language that could have been injected into the contract in advance, not after the fact, but in advance. For example, if the contract language said, hey, in the event that the lender's appraisal comes up short, the buyer is offering to make up the balance in cash at closing.
Right.
And if that's agreed upon at the onset of the contract, then there's really no issue there. The issue happens when that type of language, and that's not standard language in our contract of sale. That would have to be added and agreed to. So in a standard contract of sale, if it comes in light, then what's going to happen? The lender's going to say, okay, the appraisal came in low. Like I said earlier, they're going to lend on the lower amount, the appraised value, as opposed to the price of the contract price. And if it's an 80% loan, they're going to lend on 80% of the appraised value. So there's some decisions to be made. The buyer can either say, I'm going to make up the balance in cash at closing, no problem. The buyer could say, I can't get the loan as written, and now I might be out, and they can get out. And the seller might say, hey, let's renegotiate the deal. We'll bring it down a little bit. It can be a combination of a lot of things.
That last part, though, the renegotiation, I think a lot of people, everybody kind of fears the home inspection and they fear the appraisal. These are just critical pieces that happen in a typical transaction, and there's really no mandatory language in the contract of sale on the appraisal that says, hey, if this comes in below contract value, you've got to drop your price. The contract, at least the contract we work within our market, doesn't mandate that as an automatic. What it does, though, is that if this is a means for the financing contingency to fail for the purchaser, like you said, then the purchaser has the opportunity to fail it. They don't necessarily want that to happen. The seller might not want that to happen. So then it's hey, let's get back to talking. Let's talk about this. And, maybe the buyer and maybe even the seller thought, well, it did seem like we were pushing the market a little bit. We understand that. Let's remake the deal and kind of renegotiate on that purchase price.
Right, and I think we need to pay attention to what contract was actually used, because in the current contract that our local MLS tends to use, it's the financing contingency doesn't specifically mention the appraisal.
Right.
It's just kind of understood that the appraisal is tied to the financing.
Correct.
In the state contract, it's a little different. There is a checkbox. This deal is contingent or not contingent on the lender's appraisal. That's pretty cut and dry.
It is. And yet, even in that situation, you could also have additional language that says the buyer's going to cover the gap with cash. Or the buyer could always say, it's all good. I really want the house and I'm not worried about the appraisal that much, etc. All right, so are there things that agents and sellers, and buyers can be doing to help ahead of time to make sure that there aren't errors or there aren't mistakes, that the full picture is there? I like how you talked about, maybe the listing agent is aware of a couple of relevant data points and the background of those relevant data points. Can you share that with the appraiser, as they're preparing their report?
I think this is really important, okay? It is against the law to influence an appraiser. That's not what any agent should try to do, a buyer should try to do, a seller should try to do. The appraiser's there to do a very, very important job. And this is a loan that's probably going to be sold on the secondary market and federally insured, okay? So let me just make that as clear as possible.
Of course.
Now, what we can do, and what a buyer, a seller, an agent can do, is provide information prior to the appraisal that they feel it would be helpful for the appraiser to do their job correctly.
Correct.
So if a buyer has recently enlarged the house, but the tax records have the house at X, but the buyer knows it's 1,000 square feet larger, that'd be a great thing to tell an appraiser. If an agent knows that sale over there happened because they lost somebody to an unexpected death and they had to liquidate the house immediately and they put it on the market below market and it sold in minutes, that's a good thing to tell the appraiser in advance.
Sure. Well, the appraiser's doing a lot of that in their process anyway. We get calls from appraisers that are working on deals that we're not a part of, but they're looking at relevant data points and they want to know the backstory of what that sale was.
An appraiser is required to validate the information they put into the appraisal.
Sure.
And so a good, skilled appraiser is going to pick up the phone and is going to call the listing agent, going to call the buyer agent, going to validate and understand that. Whether or not that happens, I mean, every case is different, but that's what they need to do. So when you're proactive and you give them information that you're aware of, that's helping build their work files. So they're very appreciative of that.
And two extra points on that is it pertinent to, let's say the property that we were talking about sold with multiple interest and it sold really quickly and the market was all over it. Is it pertinent to share that as the listing agent to the appraiser so they know, again, what the mood of the market was around that?
Without question. If there are multiple offers presented on a property, that's key information to know. How the market responded to the listing, how fast it responded to the listing. These are key elements. The appraiser's obligated to talk about the marketing history of it. How long was it on the market? How many offers came in? If they have that information, that really helps them dial in and have confidence in their opinion of value.
Sure, right. Because again, they're trying to figure out what's the mood, what's the tempo of the market.
And again, this is all important to do in advance.
Of course, right.
And not after the fact.
And so what about in advance providing information as a listing agent about the special finishes? Appraisers don't necessarily know about every final finish or what the value of something is, or they might not even know necessarily that the property was renovated, completely in the last 3 years. Or bringing that kind of information up front is all good, valid information to make sure they've gotten all the data that's appropriate for them to make their own decision. I realize we're not trying to influence the decision, but you wouldn't want them to go off in a direction without having all the pertinent information.
It's so smart. I mean, it could be something, let's just say there's a private beach access that this one property has access to, but maybe the one that sold down the street doesn't have access process.
Right.
And it's not clear. Maybe it's not laid out. So that would be a great thing to say up front, because there's a differentiator there of why this one probably should sell more than that one.
100%. So, you think about appraisers, everybody's only got 24 hours in a day. So how much time do they really have to spend on site scoping those things out? I know they're supposed to be doing measurements. They're supposed to be looking at every nook and cranny, but anything that can be done to help them in their process, I think just makes it an easier way for them.
Yeah, it makes it more accurate, and that's what we all want, right?
100%.
We all want accuracy. We want, if there's a problem, let's talk about it. If a buyer and seller came to terms on something and it is way above market, let's find out why and let's get to the right. We don't want that to happen after the fact.
That's right. So appraisals are not the necessary evil of a contract. They are an important aspect, especially for, maybe even to help not just the bank, but also the buyer and the seller to kind of feel like, hey, we did make a fair market deal.
Of course, it makes a difference.
All right, guys, there you are on appraisals right now, and we'll talk to you all soon.